Hello everyone, welcome to the brief discussion of syllabus that is going to be covered during week 7. During week 7, I would be covering managerial decision making under marginal costing. So as all of us know, decisions involve alternative choices. So this marginal costing technique, it is a valuable aid to management in taking many managerial decisions. So in this aspect, I would be covering managerial decision making, that is making or buying decisions, short-run decision analysis, that is which is related to sales volume related. And again on day 3 also will be covering about short-term decision analysis. And during day 4, I'll be discussing about to sell in the organization itself, or to sell or to further process, uh, and that is what will be covered during day 4. And during day 5 also that will be continued, as it involves both numerical problems as well as theory. Here in this video I will be discussing about only theoretical part of this decisions, and while during our regular classes I would be explaining about the theory, as well as we will solve some numerical problems on each of these decisions for the purpose of better understanding. So to start with, I will give you the brief introduction of what it is. So this managerial decision making, it is a useful tool for making policy decisions, for profit planning, and also for controlling the cost. So the information supplied by total cost method is not usually sufficient to solve managerial problems. There are some important managerial problems where marginal costing technique can be applied, like pricing decisions, profit planning and maintaining desired level of profit, make or buy decisions, problem of key or limiting factor, selection of suitable or profitable sales mix, effect of changes in sales price, and alternative methods of production, determination of optimum level of activity, evaluation of performance, and capital investment decisions. So to start with, pricing decisions, which is one of the decisions that has to be taken and which applies marginal costing technique. So fixing of selling prices, it is one of the most important functions of any management. Though prices are determined generally by market conditions and other economic factors, still marginal costing technique will assist the management in fixing the selling prices under various circumstances, like it would be during normal conditions, during stiff competition, during trade depression, for accepting special bulk orders, for accepting additional orders utilizing idle capacity, for accepting export orders utilizing idle capacity, and for accepting the export orders and exploiting new markets. So how the pricing decisions are taken under normal conditions? Under normal conditions, prices are based on total cost of sales, and why? Because it has to cover both fixed as well as variable cost, and in addition to provide for certain desired margin of profit. But prices can also be fixed on the basis of marginal cost by adding sufficiently high margin to marginal cost to cover the fixed cost and profits. Under other circumstances, products may have to be sold at a price below the total cost. See, for example, during days of stiff competition, or to meet the situation arising due to trade depression, for accepting special bulk or additional orders, for utilizing idle capacity, for exporting and exploring new markets, etc. The products may have to be sold at a price below the total cost based upon the absorption costing techniques. In such situations, prices should be fixed on the basis of marginal cost in such a manner so as to cover the marginal cost and contribute something towards fixed expenses. Sometimes it may become necessary to reduce selling prices to the level of marginal cost or even below the marginal cost. Then selling price below the marginal cost. The selling price of products may be fixed even below the marginal cost during the circumstances like when a new product is introduced in the market to popularize the particular product, for exploring foreign markets, for eliminating the competitor from the market, for helping sale of joint products in order to avoid retrenchment of the workers, for disposing of the product of perishable nature, for utilizing idle capacity to keep plant and machinery in running conditions, for retaining old customers and prevent loss of future orders, for avoiding extra losses by closing down the business, and for disposing of surplus stocks. These are some of the situations where the selling price has to be fixed below the marginal cost. Then, how to fix the selling price during stiff competition and during trade depression? So, when there is stiff competition, um, products may have to be sold at a price below the total cost. In such circumstances, the price should be fixed on the basis of marginal cost in such a manner so as to cover the marginal cost and contribute something towards fixed expenses. Sometimes, for eliminating the weaker competitors from the market, the price may be fixed even below the marginal cost. And during depression, also products may have to be sold at a price below the total cost. There is a fall in the price as a result of depression. The prices can be safely reduced to an extent which covers variable cost and contributes something towards fixed cost. Why? Because fixed expenses will be incurred even if the product is discontinued during depression for a short period, and in case the product can be sold at something above the marginal cost, the total loss on account of fixed expenses will be reduced as sales will recover some of the fixed expenses. So that is why it requires that the price of selling price of the product will be reduced during depression time. And if there is a serious but temporary fall in the demand of the product, the minimum price that can be fixed is the marginal cost, because selling below the marginal cost would mean more losses than the losses on closing down the business. And hence, if the product can be sold at a price equal to or more than the marginal cost, the business should be continued under such circumstances. What about accepting special orders, bulk orders, additional orders, or export orders, or exploring new markets? So what are these bulk orders means? Bulk orders, additional orders, and orders from foreign or new markets. It can be expected at a price below the normal market price for utilizing the idle capacity. Such orders are received usually asking for a price below the market price, and hence decision has to be taken to accept or reject the order. The order may be accepted at any price above the normal cost because the fixed costs have to be incurred, even otherwise there is no acceptance of the new orders or the bulk orders. Any contribution resulting from the additional sales would mean an additional profit, but due care must be taken to see that accepting an order below the market price does not affect the normal selling price, because it will affect the relationship with other customers buying at a normal price. Okay. But if foreign order has to be accepted below the normal price, keeping in view additional cost of exporting, if any direct and indirect benefits of exporting such as goodwill, subsidies, quotas, etc., then you can take a decision of accepting foreign orders or bulk orders. Then profit planning and maintaining desired level of profit. This marginal costing technique also can be applied for planning profit. Profit planning involves planning of future operations to achieve maximum profits or to maintain a desired level of profits. The change in the sales price, variable cost, and product mix will affect the profitability of any concern. Absorption costing fails to bring out the effect of such changes on the profits of a concern. Why? Because the absorption costing technique involves fixed expenses in the total cost. With the help of marginal costing, the required values of sales for maintaining or attaining desired level of profit can be ascertained. Now coming to make or buy decisions. See, sometimes making a product within an organization may incur higher cost than buying a product from outside, and vice versa. A concern has to decide whether certain product on a component should be made in the factory itself by using unused production facilities or bought from outside from a firm which specializes in it. Okay, in taking such decision, that is make or buy, the technique of marginal costing is of immense help. While deciding to make or buy, a distinction has to be made between fixed and variable cost, and the variable cost of manufacturing should be compared with the price at which the component or product can be brought from outside. And according to this, it is advisable to make than to buy if the variable cost of product or a component is lower than the purchase price. But if purchase price is lower than the marginal cost, it would be better to buy than to make itself. However, this decision is based on the assumption that fixed expenses do not increase and production facilities cannot be employed more profitably. Further, the irregularity of supply from outside, disclosure of business secrets, and non availability of surplus activity, etc., may force a concern to make rather than to buy. And hence, uh, the decisions would be taken depending on whether the availability of the product in the market is cheaper than making the product. That is, we have to compare the marginal cost of making, and if the product is available at cheaper rate than the marginal cost of making, the decision of buying the product from the market will be taken. And if the marginal cost of making the product inside the organization is less than buying the product from the market, then it is advisable to make the product within an organization. So this, for taking such kind of decisions, it is of immense help of the organization for organization, the marginal costing or the variable costing technique. And the other factor is the problem or key limiting factor. So what is this key limiting factor? A limiting factor, it is a factor which limits or restricts production or sales and which prevents a concern from making unlimited profits. It is also known as key factor. So this limiting factor means it is any factor of production like availability of raw materials, labor, capital, plant capacity, and even sales. In case a concern has two or more product lines and there is a key or limiting factor, a problem may arise as to which product should be produced more, so as to utilize the limiting factor in the best possible manner and to maximize the profits. When limiting factor is in operation, contribution per unit of limiting factor is the main criteria to assess the profitability of a product. The product which gives highest contribution per unit of limiting factor should be preferred to the one which gives lower contribution per unit of limiting factor. When two or more limiting factors are in operation, it is necessary to take all of them into consideration. And one more type of decision that could be taken with the help of marginal costing is selection of a suitable production or sales mix. When a concern manufactures more than one product, problem often arises as to the product mix or the sales mix, which will yield the maximum profits. In determining the optimum or profitable sales mix, the products which give the maximum contribution have to be retained and their production should be increased. The production of products which give comparatively lesser contribution should be reduced or dropped altogether. So, the optimum sales mix is that which gives the highest contribution. In case there is a limiting factor, the contribution per unit of limiting factor has to be considered while judging the profitability of the product. Then the next is the effect of changes in sales prices. So management is generally confronted with the problem of analyzing the effect of changes in sales price upon the profitability of the concern. It may be required to reduce the prices on account of competition, depression, expansion program or government regulations. The effect of changes in sales prices can be easily analyzed with the help of this contribution technique. Then the next alternative method, the next type of decision that could be taken under marginal costing technique is alternative methods of production. So sometimes the management has to choose from among alternative methods of production like machine work or hand work. The same product may be produced either by employing machine 1 or machine 2, and the management may be confronted with the problem of choosing one among them. In such circumstances, technique of marginal costing can be applied and the method which gives the highest contribution can be adopted, keeping in view, of course, the limiting factor. And the next type of decision that could be taken is determination of optimum level of activity. The technique of marginal costing helps the management in determining the optimum level of activity. To make such a decision, contribution at different levels of activity can be found, and the level of activity which gives the highest contribution will be the optimum level. The level of production can be raised till the marginal cost does not exceed the selling price. Then evaluation of performance. So evaluation of performance efficiency of various departments, product lines or markets can also be made with the use of marginal costing technique. Sometimes the management may have to decide to discontinue the production of non-profitable products or departments so as to maximize the profits. In such cases, contribution of different products, departments or sales division can be compared, and the one which gives the lowest contribution in comparison to sales, that is the one with lowest PV ratio, has to be discontinued. So such decisions also could be taken with the help of marginal costing. Then capital investment decisions, that is the technique of marginal costing helps the management in taking capital investment decisions. Such decisions are very crucial for the management, and the topic on capital investment decisions uh, will be discussed in detail during our regular classes. So at the end, I also will be discussing about the advantages and limitations of marginal costing. So some of the advantages of marginal costing are the technique of marginal costing. It is very simple and easy to understand. Since fixed costs are kept outside the unit cost, the cost statements prepared on the basis of marginal costing are less complicated. So it also does away with the need for allocation, apportionment and absorption of fixed overheads, and hence removes the complexities of under absorption and over absorption. Marginal cost remains the same per unit of output irrespective of the level of activity. It is constant in nature and helps the management in planning production. It prevents and carry forward of current year's fixed overheads through valuation of closing stocks. Since fixed costs are not considered in valuation of closing stocks, there is no possibility of factitious profits by overvaluing the stocks. It also facilitates the calculation of various important factors like break-even point, expectations of profits at different levels of production, sales necessary to earn a predetermined target of profit, effect on profit due to changes of raw material prices, increased wages, change in sales mixture, etc. And it is a valuable aid to management for decision making and fixation of selling prices, selection of a profitable product or sales mix, making a buying decision, problem of key or limiting factor, determination of the optimum level of activity, close or shut down decisions, evaluation of performance and capital investment decisions. It facilitates the study of relative profitability of different product lines, departments, production facilities, sales divisions, etc. It is complementary to standard costing and budgetary control and can be used along with them to yield better results. Since fixed costs are not controllable and it is only variable or marginal cost that is controllable, marginal costing by dividing costs into controllable and non-controllable helps in cost control. It helps the management in profit planning by making a study of relationship between cost, volume and profit. Further, break-even charts and profit graphs make the whole problem easily understandable even to a layman. It is very useful in management reporting. Marginal costing facilitates management by exception by focusing attention of the management towards more important areas than to waste time on problems which do not require urgent attention of the higher managements. So, limitations of marginal costing. In spite of so many advantages, the techniques of marginal costing suffers from limitations like it is based upon a number of assumptions which may not hold good under all the circumstances. All costs are not divisible into fixed and variable. There are certain costs which are semi-variable in nature, and it is very difficult and arbitrary for classifying these costs into fixed and the variable costs. So, variable costs do not always remain constant and do not always vary in direct proportion to volume of output because of the laws of diminishing and the increasing returns. Selling prices do not remain constant forever and for all levels of output due to competition, discounts for bulk orders, changes in general price levels, etc. Fixed costs do not remain constant after a certain level of activity. Further, marginal costing ignores the fact that fixed costs are also controllable. The exclusion of fixed costs from the stocks of finished goods and work in progress is illogical since fixed costs are also incurred on the manufacture of products. Stocks valued on marginal costing are undervalued and the profit and loss account cannot reveal the true profits. Similarly, as the stock are undervalued, balance sheet will not give the true picture. Although the technique of marginal costing overcomes the problem of under or over absorption of fixed overheads, the problem still exists in regard to under or over absorption of variable overheads. Marginal costing completely ignores the time factor. That is, if two jobs give equal contribution but one takes longer time to complete, the one which takes longer time should be regarded as costlier than the other, but this fact is ignored altogether in marginal costing. The technique of marginal costing cannot be applied in contract or shipbuilding industry because in such cases normally the value of work in progress is very high and the exclusion of fixed overheads may result into losses every year and huge profits in the year of completion of the job. Cost control can be better achieved with the help of other techniques, that is standard costing and budgetary control rather than by marginal costing technique. Fixation of selling prices in the long run cannot be done without considering fixed cost. Thus, the pricing decisions cannot be based on marginal cost alone. In the present days of automation, the proportion of fixed cost in relation to variable cost is very high and hence managerial decisions based upon only the marginal cost ignores equally important element of fixed costs. Important of fixed cost may not be correct. Although the technique of marginal costing suffers from the limitations, it is a very useful technique in the hands of management and is extensively used for the cost control, decision making, uh, and profit planning. So, students, I will be explaining you the one decision that could be taken, that is the effect of changes in the selling prices, by taking an example of look at this example. The data is provided from the records of a company where the sales is 60,000, variable cost is 30,000 and fixed cost is 15,000, and you have to prepare PV ratio, break even point and margin of safety at this level. Also you have to calculate the effect of 10% increase in sale price, and you have to calculate the effect of 10% decrease in sale price. So, we have to calculate PV ratio for the current level that is whatever the sales, variable and fixed cost is given. So, calculate PV ratio. PV ratio, how to calculate PV ratio is you have to divide contribution by sales and multiply that by 100, you will get the PV ratio, but we do not know contribution, we also have to calculate contribution. So, from the formula to calculate contribution is sales minus variable cost. So, sales is given and variable cost is given. 60,000 minus 30,000 will give you 30,000, which is contribution. So, now we know contribution, we know sales, calculate PV ratio. PV ratio is 50%. So, now calculate break even point. Break even point is fixed cost divided by PV ratio. So, fixed cost is 15,000 divided by PV ratio is 50 into 100. So, we will get 30,000 as the break even point. Now, calculate margin of safety, present sales minus sales at BEP. We know the present sales, we also know the break even sales. So, margin of safety is 30,000. So, now we have to calculate effect of 10% increase in selling price. So, sales is 60,000, increase that by 10%, you will get 66,000. Again calculate PV ratio, break even point. Now, PV ratio is 54.55% and break even point is 27,500. So, as profit volume ratio has increased, you need to achieve lesser sales, that is only 27,500 to achieve break even. When there is effect of 10% decrease in selling price, so again when there is 10% decrease in selling price, it comes to 54,000, and hence PV ratio will also get reduced to 44,000, that is 44.44%, and the break even point will increase, that is it increases to 33,750, and margin of safety is 20,250. So, with this you can take the decisions, that is what happens if you increase sales, what happens if you decrease sales to break even, how much profit you will get if you increase the sales or decrease the sales. That is what the decision that you could take with the help of this technique. And yeah, so this is what we will be discussing in detail in our regular classes with problems, so many problems for your better understanding of the concepts. So, friends, we will discuss in detail the topics that I told you that are going to be discussed during week 7 of our classes. So, thank you for your patience listening.